Crypto can feel overwhelming when you're just starting out. Charts move fast, everyone talks like an expert, and social media is full of quick win promises. But the truth is, building your first crypto portfolio doesn't have to be complicated. You just need a simple plan, basic knowledge, and the right mindset. Let's break it all down step by step so you can start safely, confidently, and without the confusion. 1. Understanding what crypto actually is. Before you buy your first coin, you need to understand what you're dealing with. Crypto isn't just digital money. It's a collection of different technologies, assets, and communities built on blockchains. A blockchain is basically a public database that no single person or company controls. It records transactions in a way that's secure and nearly impossible to tamper with. There are thousands of cryptocurrencies, but not all are meant to be investments. Some are used for payments, some are used to run applications, and others exist within gaming or decentralized finance. What matters is knowing the difference between a major, secure ecosystem and a risky experimental token. When you understand that, your decisions become smarter from day one. 2. Setting clear goals before you start. Jumping into crypto without goals is one of the fastest ways to lose money. Your goals shape everything: what you buy, how much you invest, and how long you hold. Ask yourself a few honest questions. Are you investing for long-term growth? Do you want small, steady gains or higher risk, higher reward results? How much money can you afford to lose without stress? Do you want a simple portfolio or a more diversified one? Most beginners do best by keeping things simple: steady investments, long-term outlook, and avoiding emotional decisions. Crypto becomes easier when you know what you're aiming for. 3. Choose a safe and reliable exchange. Your crypto journey starts with picking the right exchange. Think of an exchange as the place where you buy, sell, and store your digital assets. Popular beginner-friendly exchanges include Coinbase, Binance, Kraken, and others that operate legally in your region. A good exchange should offer strong security, easy verification, clear user interface, good customer support, lower transaction fees. Avoid any platform that feels suspicious, promises guaranteed returns, or asks you to send money through strange payment methods. If an exchange has a shady reputation, don't touch it. 4. Learn the difference between hot wallets and cold wallets. Once you buy crypto, you need to store it safely. This is where wallets come in. A hot wallet is connected to the internet. It's easy to use and great for beginners, but slightly more vulnerable to attacks. A cold wallet is offline, like a hardware device or USB-like tool. It's safer but requires a bit more setup. A smart approach is to start with a hot wallet for small amounts, then upgrade to a hardware wallet once your portfolio grows. The golden rule is simple: if you don't control the keys, you don't control the crypto. 5. Start with the big, proven coins. When you're new, the safest place to start is with the major cryptocurrencies that have a long track record. The two most common beginner anchors are Bitcoin, BTC, digital gold, slow but stable long-term store of value; Ethereum, ETH, the backbone for smart contracts, apps, and most crypto innovation. These coins aren't guaranteed to rise, but they're far more secure and established compared to random altcoins that can disappear overnight. A typical beginner portfolio might start with 50% Bitcoin, 30% Ethereum, 20% spread across other coins you research and trust. Keep it simple at first. You can always diversify later. 6. Learn basic crypto research before buying anything. Research is the skill that separates long-term winners from emotional investors. Before buying any coin, answer a few basic questions. What problem does this coin solve? Is the team credible? Does it have real-world adoption? Is the community active and growing? Is the token supply limited or unlimited? Are major exchanges listing it? If a coin doesn't pass these tests, skip it. Crypto is full of hype and marketing, and rushing into the next big thing can drain your wallet quickly. 7. Dollar cost averaging, the easiest beginner strategy. Trying to time the market is extremely difficult, especially in crypto where prices swing daily. A safer strategy for beginners is dollar cost averaging, investing small amounts at consistent intervals. For example, $20 every week or $100 every month. Over time, this approach smooths out volatility and reduces emotional stress. You don't have to worry about buying at the peak or catching the perfect bottom. 8. Avoid meme coins and hype traps in the beginning. Meme coins like Shiba, Doge, and others can be fun, but they're also unpredictable. People buy them hoping for huge gains, but most beginners don't understand the risk. Many meme coins skyrocket one week and crash the next. Some disappear completely after developers abandon the project. You can explore them later once you understand the market, but don't build your foundation on hype. Beginners should prioritize stability, not chaos. 9. Track your portfolio and stay organized. A growing portfolio can become messy if you don't track your assets. Use apps that help you monitor prices, performance, and growth. Many apps allow you to see everything in one place, including trends and historical charts. Tracking helps you avoid panic selling, emotional decisions, and confusion. It also helps you see your progress over time and keeps you disciplined as your strategy develops. 10. Be prepared for volatility. Emotion is the enemy. Crypto goes up fast, and it crashes even faster. Emotional reactions hurt beginners more than anything else. When prices rise quickly, people chase the pump. When prices fall, people panic and sell at a loss. Both reactions are the opposite of smart investing. The best mindset is simple. Stay patient. Stick to your plan. Don't react to temporary swings. Focus on long-term movement. If you expect volatility from the start, you won't be surprised when it happens. 11. Don't put all your money in crypto. Even though crypto can be rewarding, it shouldn't be your entire investment strategy. A healthy portfolio includes traditional assets like stocks, savings, real estate, or businesses. Crypto should sit beside those assets, not replace them. The general rule is never invest money you can't afford to lose. Crypto is powerful, but it's also unpredictable. 12. Stay updated without getting overwhelmed. The crypto world changes constantly. New updates, new projects, new regulations, it moves fast. But you don't need to absorb everything. Follow a few trusted news sources or YouTube creators. Ignore the noise. Staying informed keeps you safe and helps you adjust your strategy as the market evolves. 13. Build slowly and avoid rushing. The biggest mistake beginners make is trying to get rich quickly. Crypto rewards patience, not speed. When you build slowly, you avoid burnout, stress, and reckless decisions. Set monthly goals, review your progress, and focus on long-term growth. Most successful crypto investors didn't get lucky, they got consistent. If this guide helped you understand where to begin, hit the like button and subscribe for more practical breakdowns. Drop a comment below. What's the first coin you're thinking of adding to your portfolio? Thanks for watching and take your time. Smart investing always pays off in the long run.